Based on what we saw yesterday, AI enthusiasm in markets has not died down. Welcome back to the AI Breakdown Brief, all the AI headline news you need in around 5 minutes. Today we are starting off with a look at market enthusiasm surrounding AI, expressed in both public and private markets yesterday. One of the big stories, and really one of the big things that market observers were looking to as a bellwether for how much enthusiasm there remained for AI stocks, was the IPO of ARM. ARM is an AI chip company that we've talked about on previous episodes, who doesn't manufacture chips themselves, but sells plans for chips that others can manufacture. Now, one thing that's important to keep in note is that tech stocks in general, and IPOs specifically, have had a rough go of it for the last 18 months or so. That is, of course, driven by the fact that we've had the fastest rate hiking cycle in history, following an extended 12 to 14-year period of near zero interest rates. And yet that AI enthusiasm did indeed continue on. ARM was up 25% from its initial offering price in the first day of trading, and the IPO was 12 times oversubscribed. Now, if you were watching or listening yesterday, you heard me talk about Goldman Sachs' recent report, Why AI Stocks Aren't in a Bubble, and I guess depending on your priors, this could either confirm or deny Goldman's thesis that we are not. For those who didn't hear that episode, basically Goldman's argument is that although yes, there is a ton of enthusiasm around artificial intelligence, if you look at the PE ratios of previous tech bubbles, the top companies benefiting from AI enthusiasm aren't anywhere near the PE ratios of companies at the top in previous bubbles. Interestingly, Goldman also pointed out that the quote-unquote early winners were this set of infrastructure companies, including, quote, makers of semiconductors needed to build AI technology and cloud service providers with the computing infrastructure to commercialize it. They noted that those near-term AI beneficiaries were up much, much more than long-term AI beneficiaries in the first 8 months of 2023. ARM would definitely fall into that category, and so I think in many ways the IPO performance yesterday adds evidence to Goldman Sachs' thesis. Now, private markets were no less active, and there were at least two notable deals. The first was Databricks, which raised an additional $500 million at a $43 billion valuation. According to CEO Ali Ghodsi, the new round, which was technically a Series I believe, was sparked by inbound interest from NVIDIA. Ultimately, T. Rowe Price led the round and was joined by NVIDIA, Capital One, the Ontario Teachers Association, Andreessen Horowitz, and many, many more. So what does Databricks do? Basically, they help companies organize all of their data, which is, of course, a prerequisite for getting the most out of artificial intelligence. More recently, they've been helping companies use that data to train their own custom LLMs or to take advantage of and customize open source models that exist more widely. A month ago, the company made news when a tie-up with Microsoft came out, through which Microsoft's enterprise Azure platform would offer access to Databricks, in a move that many saw as competitive with Microsoft's other big investment in the AI space, OpenAI. Now, to many observing Microsoft's behavior, it reflected the reality that the AI space is extremely fast-moving and dynamic, and it appears like enterprises might be a little bit more focused on getting custom solutions that work with their data without having to rely on entirely separate services like OpenAI, and this was a way for them to adapt to that reality. Around this new funding, Databricks CEO Ali Ghodsi again talked about that exact weird relationship. Ghodsi said, "It's the nature of the business. We're both a customer and a competitor, but all of the clouds would rather have our business than not. It's a land grab right now in AI." Now, certainly given this funding and Databricks' hot spot in the AI markets, many are looking at them as a promising IPO prospect as well. However, currently reports are that the company is burning a huge amount right now. Indeed, they appear to be in that old world zero interest rate mindset of growth at all costs rather than profitability, although Ghodsi did say that his company could flip to profitability within 2 quarters if it felt the need to do so. Another startup turning heads with its fundraise is a European startup called Hing. The company raised a $223 million Series B led by General Catalyst, and the round was also joined by Swedish heavy industry and defense group Saab. Now, this company is notable for a couple reasons. First, it's backed by Spotify founder Daniel Ek, and represented part of his pledge to put his money to work funding deep tech moonshot projects. He had previously funded Helsing with a €100 million investment. Now, in terms of what this company does, as TechCrunch puts it, its AI platform claims to be able to boost defense and national security specifically for liberal democracies by making them more efficient using live data. By way of example, quote, "In June this year, the German government selected Helsing and Saab to provide AI-enabled electronic warfare capabilities for the Eurofighter jet fighter. And this month, Helsing and its consortium partners won the contract to provide the AI backbone for the Future Combat Air System program." There is so much that we could dig into here about what trends this reflects. Of course, on the technology side, it's an AI company, but it's also an AI company in the defense and the military space, which is something that we are seeing just a huge amount of. What's more, I do think it also shows geopolitical changes. In the wake of Russia's invasion of Ukraine, obviously the European military establishment has gotten a very different perspective on its own existence and has really started to ramp up investment, and this appears to be an example of that. One more fundraise for the sake of completeness. Pixie is a company that promises an AI-powered platform for brands to monitor and orchestrate their marketing campaigns, also announced an $85 million Series C round. Now, I've talked before about how marketing is just one of the most obvious areas for AI. It's an area that benefits from understanding and taking advantage of huge amounts of data. It's an area that involves creating a ton of content. And candidly, it's an area that already has made lots and lots of trade-offs between creativity and artistic integrity and raw efficiency and salesmanship. That's not a critique. That's just saying that marketing is an area that is going to have less scruples, let's say, about adopting AI than perhaps some other fields will. Speaking of fields that perhaps have a little bit more of a challenge with the adoption of AI, the strikes in Hollywood continue, but an interesting new announcement this week shows that in addition to union negotiations, part of the path forward may be new technology companies and different business approaches to AI as well. On Thursday, a company called Metaphysic announced a partnership with CAA, through which it claimed that CAA's talent, such as Tom Hanks, Rita Wilson, Paris Hilton, and many others, will effectively be able to manage how third parties use AI versions of their likeness, including their face, voice, and performance data. Now, the announcement is fairly scant on details, but they say that the platform includes consent, compensation, issues of copyright. It basically represents a way for celebrities to try to take hold of AI representations of themselves and benefit from them, rather than be cut out and relegated to the sidelines. Now, I don't know the specifics of Metaphysics yet, and obviously there remain big questions about how the union negotiations resolve, but at the same time, it does feel inevitable in any entertainment sector that part of the answer, at least, is going to be sanctioned AI platforms and sanctioned AI uses that cut the people whose likeness or talent or voice or face is being used into the economics of that usage as a new opportunity and revenue stream. I think it is by far the most likely outcome that this is what we see in music as well, with some amount of bifurcation between actual artist-created music and AI-generated music using artist voice and likeness that still goes through some whitelist or blacklisting process and gives those artists the ability to make money just from existing. Lastly today, one more area where the AI future is a little bit controversial. One might think that the gaming industry is completely ripe for not disruption by AI, but to leverage AI for really innovative and new types of experiences. Obviously, we've seen efforts around non-player characters using ChatGPT for more realistic dialogue. There are really interesting companies out there that are making it much easier to create 3D worlds. But on the flip side, you have companies like Valve, who through their Steam platform seem to be taking a hardline stance against AI-generated content in games. Well, Bain Consulting has come out with a report in which they suggest that while less than 5% of video game content today is developed with generative AI, within 5 to 10 years, an entire 50% of video game content will be developed with support from generative AI. This is getting a lot of chatter on Twitter and X, but frankly, I'm taking the over on this one. I think that the ability for game designers to create these incredibly immersive worlds, to have more realistic interactions with people, all of the opportunities basically of AI are going to so radically outweigh the pressure to go the other direction. I just think it's going to become a huge tool in the games industry, in spite of these furtive efforts to take some sort of ethical stance against it. But I'm by no means a games expert. I could be wrong. In any case, that is going to do it for today's AI Breakdown Brief. I hope you enjoyed this, and I'll be back soon with the main AI breakdown.